Hey, good evening, everybody. Dan Roach here. Happy Sunday. I hope you've had a good weekend. Let's jump right into it. Brought to you by University of Options. I don't know why I do that. You know where it's coming from. Just the promoter in me, I guess. All right, so a lot of interesting things going on. Mixed bag of reporting on the inflation slash economy front, and the stock market is really crossed up with two very distinct possibilities. So we'll look at these together and see what we can come up with. First of all, inflation expectations going out 1 year. These are consumer expectations. That's a pretty big jump there. And then 3 year and 5 years. So consumers have the 3 year very much the same. 5 year would drop a bit, but the 1 year is a little bit stronger. It's probably not too unreasonable. I personally think we're going to see inflation well below 2% in the coming months. And then GDP, the Fed Now site, GDP Now, is now back over 2%. Last week, they were showing a 2.5% recession or drop in inflation. And now what we can see here is that the range of the top 10 and bottom 10 average forecasts is below 1%. And in fact, it gets down to -1. This is looking at the correlation between the Citibank Surprise Index and Treasury bonds. And so clearly what you can see here is that as the economic surprises have jumped, so have the Treasury yields. And yet it's been coming down very steadily since January, maybe December. And you can see here that the Treasury yields were falling, got down to here, like 4.1. And now these two are they're divergent. They're moving away from one another. So what do you believe? Do you think the economic surprises will jump and justify these yields, or will it continue to drop and see these yields come down? I certainly think it's the latter. Recession fears. Are we in a recession? Google searches. It's the second highest of all time. So if this many people are having to ask if we're in a recession, this is the second highest of all time. We might just be in a recession. Leading economic index. It's not the most reliable index at all, but overall, but it's worth looking at. And you can see that the LEI, that's the leading economic index for the US, is telling us the economy is growing close to trend. Doesn't really tell you much of anything other than for status quo, should remain the same course we're on. Home purchase sentiment dropped, no surprise there, because I think we saw rates kind of bump up as well. So this is something you want to watch. These are the components of the home purchase sentiment index. And you can see that in terms of buying conditions, only 23% are saying it's a good time to buy a home. 77% are saying it's a bad time to buy a home. Sellers, 58% say it's good, 41% say it's bad. So this tells you that you're pretty much moving into a buyer's market, which we haven't seen in a long time. And then the home price outlook, more people think they'll go up and down, so that's good. Mortgage rate outlook, people are thinking they're going to go down. Only 26% of people think that. So this was interesting too. Job loss concern, 25%, which is not a tiny number, think it's not a good time to buy because they're concerned about their jobs. And then mortgage demand, you can see here that each one of these colors means something else. So the purchase index, really flat, not high, not strong. The refinance index, horrible. And then the overall market index is pretty horrible. And that's all because of what's up here. So you can see that as rates fell, then you can see that these indexes went way up. High is good, low is bad. So we're not going to see these numbers come up until we see rates come down. Rent prices are pretty much holding steady. We've seen a little bit of an increase. That's important because rent's a big component of GDP. But now you can see the median rent in the US was, what does that say? About $1,400 in 2025. Used car prices is something we just look at every once in a while because they can be very telling in terms of overall market dynamics, inflation, etc. And it's right down the middle. It's higher than it was back in the 2000 area, but it's much lower than it was kind of post-COVID. Wage growth tracker, well, there isn't. So overall wage growth was unchanged at 4.3. Growth for job stayers held at 4.4%. That's not enough to really drive the economy here. I'm not going to read this to you, but it's always interesting when the Fed speaks because he sticks to the same script pretty much every time, other than what's in the red. What's in red are things that are different that he may have said last time that he didn't say this time. So it's kind of cool to look at this and you can see how the Fed's thinking has changed from meeting to meeting. These slides and get that as well. And the Fed clearly is signaling that it'll lean toward the side of its dual mandate, which is the goal. One is that inflation is under control, and the other is the job market is strong. And based on these two things, it's reasonable to conclude the Fed will not be cutting rates in the near term. I think that's really clear right now. Inflation swaps. So traders say that tariffs mean transitory inflation. We'll see. There's the 1 year inflation swap has jumped pretty big, and going 1 year forward, it's back down here. So somewhere in here probably what makes sense. The bottom line is tariffs are believed to maybe have a little bit of a drag on inflation. And then the market's putting the odds of a recession at 50%. Now that peaked in May 1st, just last week, at 66%. So what happened between now and then? I don't know. Maybe something the Fed said, but still 50% of the public thinking there's going to be a recession. It's not necessarily good. All right, let's see what all that meant for the market. So institutional risk appetite. Remember, the institutional players drive the market. They buy more than the retail investors by far. And you can see that they've kind of been in the sidelines. Even though the market's rallied a lot in this last week, they're still on the sidelines, which tells you there's some good upside in the market. The put to call ratio, this is the 5-day moving average, and it's fallen back to the lower threshold. So this is telling you that right down the middle. So if you have lots of puts being purchased, that's bearish for the market. And when you have lots of calls being purchased, that's bullish for the market. And you can see we're kind of right where we've been. So the market's really at a crossroads. Weekly inflows, not. Money's actually flowed out of equities. This was the biggest 4-week outflow from U.S. stocks since May of 23. So more money flowed away from stocks than we've seen in the last 2 years. And then tech funds, same thing. They saw the biggest outflow that we've seen in 11 weeks. Tech's usually going to lead into the problem and out of the problem. Announced buybacks. So 2025, which is our blackish line here. Is that making sense? And this is telling you how many companies are telling you that they're going to be buying back their shares. And 2025 paces at the biggest year for the S&P buybacks. So you got to go into here. You can see how that's going straight up. That's what I was missing the first time. A lot of companies plan on buying back their stocks. That is going to keep prices very firm. And then this is CTA's Commodity Trade Advisors. Their position is, I would say, negative more so than positive. They're certainly not fully in the market right now. That's something to watch out for. And then this is the S&P versus the VIX. Remember, the VIX is the stock. It's really an index. You buy the options when you think the market's going to go down. The VIX will go up when you think the market's going to go down. Oddly enough, the VIX fell 5 straight weeks. Total decline was 10%. And when that's happened in the past, this green is telling you what's happened to the overall market. So you can see getting outside of a week, it's extremely favorable. The overall market, when VIX has declined that much, you can see 100% of the time, 2 weeks, 1 month, what is that, 9 months, 1 year? So very favorable if you want to believe the history, that could be a very strong statement for the stock market. And monthly returns, the S&P gained 14% from the low posted 1 month ago. That represents the best 1 month return since 2020. That's staggering to me. That's a huge increase in the stock market. And a lot of people missed it because it kind of just snuck up on us. Seasonality, this shows you that right now we are in a very seasonally strong period, and that we could see many of the major indexes pushing above their 200-day moving average sometime after mid-month. So this is a pretty bullish slide here. Price earnings ratios. So the market bottomed at 18 times earnings on April 8th. So that means for every dollar earned in the S&P, the stock, the company, every dollar the company earned, its stock was at $18. Now, that is down from 20, and it's not likely to bounce back to the 22 we saw at the beginning of the year. But so it's good. The market was overpriced, and now it seems to be a little bit more fairly priced. Then we have the AAII sentiment survey. It hasn't changed much, still much more bearish than bullish, beginning to maybe close down on itself, but at this point, it's still not great. And then this is the AAII asset allocation, and you can see that it's highest since 2023. Sorry, so stocks are the lowest since 2023. Bonds are kind of middle, and cash is highest than it's been. So that tells you people are not interested in stocks. They're very interested in cash and bonds. And then this is the purchase managing, the name exposure index. It rose more in a year. You can see this huge jump here. So these guys are bullish. Yeah, it's a pretty bullish slide. Corporate buybacks in April is just unbelievable. So again, stocks can't go down when companies are aggressively buying them back. I think this had a lot to do with the recent rally we've seen. Companies just jumped in and started buying. And then this is companies that are lowering their guidance versus raising their guidance. So far in May, with 781 companies reported, 69 have reported higher guidance, so they're going to make more than they thought. 45 are saying less. And that's quite a big change from April, where 27 were saying things would be better and 43 are saying things would be worse. So it really flip-flopped. And I don't know, again, what caused that, but suddenly people are a little more bullish about their earnings. All right, let's look at a couple stock picks. I got to tell you, I don't know if this is going to be popular or not popular, but I have changed the format a little bit in terms of the stocks that I pick, and I'm only going to pick 1 to 2 each week. And this comes from some surveys that we've done, and we learned that most people were finding 5 picks overwhelming. And so instead of, trading them all, felt they should trade them all or not trade them at all. And there was some truth to that, because when I picked this basket of stocks, the idea is that you want to use probabilities in your favor. And if you're buying them all, there's a higher probability that this works. So now we're going to take it down to 2 stocks and tell you that if you like them, I'm not advising you. I'm not an advisor. You have to decide. But if you like them, these are probably going to be stocks that have a little more research behind them. First, again, I want to tell you, check this out. You can send a note to dan@universityofoptions.com. And what I'd love to invite you to do is to come into our live trading room and watch me trade it for a few mornings. You'll be pretty surprised. You'll literally be able to see that we make money every day. Well, we have losing days, but not very often. These are just a bunch of members' wins. Lots of them. And then I want to show you this. It's kind of fun. So every morning I get up extra early because I'm on the West Coast, and I pick between 1 and 3 stocks that I believe when the market opens could really run. And I give you the exact level that I think you should enter them, and I give you the target. So these are just 2 from the end of last week. One was Groupon. You can see that I said to buy it here. I think I cut this off, but it was about $18. And you can see what happened to Groupon. So I said buy it at, call it $18.90. The stock ran up to $24 without even pulling back for 1 second. And that happened virtually about the time the market opened. Had you gone in when I said, you would have done really well. And then I also looked at Crocs. And Crocs, we said to enter it above 105.50. I gave you the target. This is what the chart looked like in the morning when I picked it. And then this is what happened after the open. Stock went from 105.50 to over 111 in just a couple hours. So if you want to get these picks in the morning, again, Dan at universityofoptions.com. I do them just about every morning, and just about every morning we have 1, 2, or 3 stocks really take off because the system we use works. That's all I've got to show you the stocks. Sorry. So last week we had 1 loss, we had 3 wins, we made 1.1%. And had you bought the options, you can see here you would have had a 10% return on your investment. So you spent $410, 1 contract of each of these, you would have made $451. So 10% return. That is old. This is new. So pause. This is a silver company. I think silver's relative to gold pretty, I think it's undervalued right now. And it's been on a tear for the last few months. I don't think that's over. I think that if silver can get above 27.30, it should really run. And you can buy this option, this call option expiring May 30th. So 20 days out, spend about 75 cents a share for it. And I think you'll probably see a pretty big return. No guarantees. You have to decide for yourself. And then Lumen Technology, it triggered all kinds of interesting things I don't have time to go into, but I'll just tell you that if Lumen can get above about 450, should really run. And that option, it'll cost you only 26 cents a share. Call it, $25. You make this bet, and I think you'll be pretty happy if the stock does what I think it's going to do. Okay, that's all I've got. Reach out if I can help you, Dan at universityofoptions.com. And you guys have a great week. Bye.